Alibaba has moved above $100 and has been on the rise through 2024, bringing it back onto people's radar as an investment opportunity. However, before getting too excited, it has a long way to go to recover from its previous 81% decline. Alibaba, with its $264 billion market cap, sits comfortably as the world's 40th most valuable company. That's impressive, but to truly understand this recent 60% surge, we need to zoom out and look at the bigger picture. Let's take a journey through Alibaba's history from its humble beginnings to its current state. Back in 1999, Jack Ma, a former English teacher in China, along with 17 co-founders, launched Alibaba with a vision to revolutionize global commerce. Their goal? To empower small and medium-sized enterprises in China to reach international markets without breaking the bank on infrastructure. It started as a B2B portal connecting Chinese manufacturers with overseas buyers, and boy, did it grow from there. Jack Ma's vision was truly revolutionary at the time. He saw the internet as a great equalizer, a tool that could level the playing field in global trade, especially for smaller players who traditionally lacked access to international markets. This vision wasn't just about business, it was about changing the very fabric of global commerce. Fast forward to September 19th, 2014, Alibaba's IPO day. This wasn't just any IPO, it was a record breaker. Listing on the New York Stock Exchange under the ticker BABA, the company priced its shares at $68 each, valuing the company at a whopping $168 billion. They raised $21.8 billion, which ballooned to $25 billion after underwriters exercised additional options. This made it the world's largest IPO at the time, surpassing the Agricultural Bank of China. The market's response? Enthusiastic to say the least. Alibaba stock closed its first day at around $94, a 38% jump from its IPO price. This wasn't just a win for Alibaba, it was a statement about the growing influence of Chinese tech companies on the global stage. But here's where it gets interesting and where we start to see the volatile nature of Alibaba stock. The stock market, as we all know, is never a smooth ride. After that initial 30% rise in the first 3 months, Alibaba took a nosedive, plummeting 52% between 2014 and 2015. Why? Well, it was a combination of factors that came together. First, China's economy was showing signs of slowing down. Second, regulatory concerns started popping up. And third, Alibaba was struggling to meet sky-high market expectations. Add in some global market volatility and you've got a recipe for significant downturn. When lockup periods expire, typically 6 months after an IPO, pre-IPO investors are allowed to sell their shares. This often leads to a significant increase in stock supply and can put downward pressure on the stock price if many choose to sell. But here's where Alibaba's resilience starts to show. From that 2015 low of $57, the stock embarked on a spectacular bull run, soaring 260% to reach $212 by 2018. This boom was fueled by a combination of factors that showcased Alibaba's strength and adaptability. First and foremost, Alibaba demonstrated strong earnings growth during this period. The company consistently reported significant revenue increases driven by its core e-commerce business. But it wasn't just about e-commerce anymore. Alibaba was expanding into new markets, including cloud computing and digital media ventures. This diversification strategy paid off, reassuring investors about the company's profitability and market dominance. Speaking of cloud computing, Alibaba Cloud emerged as a major growth driver during this period. It rapidly increased its market share in China and started to expand internationally, positioning Alibaba as a serious player in the global cloud computing market. Another factor that contributed to this boom was the increase in consumer spending in China. Rising middle-class incomes and increased internet penetration created a perfect environment for Alibaba's platforms. More people were shopping online and using Alibaba's services for a variety of needs, from e-commerce to digital payments. The company also made several strategic acquisitions and formed partnerships that expanded its business portfolio and fortified its market position. The company also significantly improved its monetization strategies, particularly in mobile. By successfully integrating mobile advertising and shopping, Alibaba was able to boost its mobile revenue significantly, addressing one of the concerns that had contributed to its earlier stock decline. However, the good times couldn't last forever. In 2018, Alibaba faced another 38% decline. This downturn was primarily driven by external forces rather than company-specific issues. Simultaneously, China's economic growth was showing signs of further slowdown. Regulatory scrutiny on large Chinese tech companies was also increasing. Concerns about stricter regulations on technology, finance, and other sectors began to surface, which could impact company operations and profitability. This regulatory uncertainty added another layer of risk for investors. But Alibaba wasn't done yet. Between the 2018 low of $130 and its all-time high in 2020 at $319, the stock went on another impressive run. This surge was driven by a recovering Chinese economy, expansion of services, especially in cloud computing, strategic investments in Southeast Asian e-commerce platforms, and the global e-commerce boom fueled by the COVID-19 pandemic. And then it all went wrong for the company when it was hit with the mother of all stock market crashes. From its 2020 peak to the 2022 low, Alibaba plummeted a jaw-dropping 82%, bottoming out at $58, right back where it was in 2015. This massive decline was primarily due to intense regulatory crackdowns by Chinese authorities, including a $2.8 billion antitrust fine. The regulatory issues began with the halting of the Ant Group IPO in late 2020. Ant Group, a financial technology affiliate of Alibaba, was set to have the world's largest IPO. The suspension was a direct result of regulatory concerns over financial risks associated with non-traditional financial institutions. This event sent shockwaves through the market and was just the beginning of Alibaba's regulatory troubles. In 2021, Alibaba was hit with a $2.8 billion fine by Chinese regulators for antitrust violations, specifically for practices that stifled competition. This was part of a broader effort by the Chinese government to regulate large tech companies, which had previously operated with relatively little oversight. Add in China's economic slowdown, deteriorating investor sentiment, particularly among foreign investors, and challenging global market conditions due to the ongoing impact of the COVID-19 pandemic, and you've got the perfect recipe for a stock market disaster. Since then, we've seen a temporary bounce of about 110% in late 2022 and early 2023, but the stock has largely remained in consolidation between $120 and $58 from 2022. And that brings us to today with this 60% rise in 2024 that's got everyone talking. Now, here's where I need you to pay close attention. This 60% increase, while impressive, needs to be put into perspective. Alibaba is still deep in consolidation, and it has every potential to whipsaw up and down within this channel for the foreseeable future. We really need to see a solid breakout before getting too excited. I'm seeing financial influencers hyping up this stock right now because of the 60% increase this year. But let me be clear, this stock could just as easily swing back to that $58 low. That's the nature of consolidation periods. They're unpredictable and can trap investors who aren't prepared for the potential volatility. So, what's an investor to do? Well, you've got two main options. Option one, jump in now on the hype, but be warned, you could be stuck in this sideways market for a long time. We're talking months, potentially even years. Just look at Citigroup as an example. After its almost 100% decline from 2006 to 2009 back to its IPO price in the 80s, it has since traded inside a consolidation for 15 years. While Alibaba might not take that long, even a year is a significant time to hold a stock with no growth when there are plenty of other performing stocks out there. Option two, this is my preferred approach. Wait for a clear breakout from this consolidation. We're looking for a close above the high of the consolidation, which is around $120. But don't jump in right away. Wait for confirmation that the uptrend has started. This means allowing for further movement and breakouts to the upside. Why am I so cautious? Because fake breakouts are real and very much part of a stock's performance. That's when a stock moves out of consolidation, shows early signs of an uptrend, and then fails, reversing back into consolidation. These fake breakouts catch a lot of eager investors off guard. Patience is crucial when stocks first break out of a lengthy consolidation or sideways period. Once an uptrend is confirmed, that's when I'll consider a position. At that point, the odds are more in our favor for the stock to potentially rise back towards its all-time high, which would be about a 160% increase from current levels. Alibaba's future isn't just about its stock price. It's about how the company navigates regulatory challenges, expands globally, innovates technologically, and maintains its competitive edge in a rapidly evolving digital economy. Factors like Chinese economic recovery, global expansion success, and restoration of investor confidence will all play crucial roles in Alibaba's potential return to its glory days. One standout stock in the tech sector is Palantir, which has already surged almost 160% in 2024 alone, establishing itself as a leader in the AI space. Find out in this video whether Palantir will go on to reach record highs and offer opportunities for increasing your portfolio's profitability.